What if I told you that Warren Buffett, one of the greatest stock pickers in history, a man who has spent decades studying individual companies better than almost anyone alive, has publicly said that when he dies, 90% of his own wife's inheritance should be put into a single, boring investment, an index fund? Let that sink in for a second. The man who built his entire fortune by picking individual stocks is telling the people he loves the most to avoid doing what he does and instead put their money into something almost embarrassingly simple. So either Buffett is being modest, or there's something about index funds that even the smartest investors in the world respect more than flashy stock picking. Today, we're going to break down exactly why the wealthy, the financially educated, and even legendary investors keep coming back to this one simple tool. And by the end of this video, you'll understand something that most people never learn until they've already made expensive mistakes with their money. So stay until the end, because the last part of this video is honestly the most important piece of the entire puzzle. Let's start with the basics, because a lot of people hear the term index fund and immediately assume it's something complicated, something only finance professionals understand. In reality, it's the opposite. An index fund is simply a basket of stocks that mirrors a specific market index, like the S&P 500, which tracks 500 of the largest companies in the United States. Instead of trying to guess which single company will perform best, an index fund basically says, let's just own a small piece of all of them. When you invest in an index fund, you're not betting on one company's success. You're betting on the overall growth of the entire economy, or at least a large, diversified section of it. Now, here's where it gets interesting. You'd think that with all their money, all their access to expert analysts, and all their connections, wealthy people would be the ones picking individual stocks and beating the market constantly. But study after study shows something surprising. The vast majority of professional fund managers, people whose entire job is picking winning stocks, fail to beat simple index funds over long periods of time. Some studies show that over a 10 to 15-year period, more than 80% of actively managed funds underperform their benchmark index. Let that number sit with you for a moment. Highly trained professionals, with access to information most of us will never see, still lose to a simple, unmanaged basket of stocks more often than not. So why does this happen? Why do the experts, the ones getting paid enormous salaries to beat the market, so often fail to do so? The first reason is fees. Actively managed funds usually charge higher fees because you're paying for a team of analysts, researchers, and fund managers to actively pick and trade stocks. These fees might sound small on paper, maybe 1 or 2% a year, but over decades, that small percentage quietly eats away an enormous chunk of your total returns. Index funds, on the other hand, have dramatically lower fees, sometimes as low as 0.03% a year, because there's no team of analysts trying to outsmart the market. The fund simply mirrors the index, and that simplicity translates directly into savings that compound in your favor over time. The second reason is consistency. Picking individual stocks that consistently outperform the market year after year, decade after decade, is extraordinarily difficult, even for professionals. A fund manager might have an incredible year, beating the market significantly, and then have a terrible year right after, wiping out those gains and then some. Index funds don't try to have an incredible year. They simply aim to match the market's overall performance, which historically, over long periods of time, has been remarkably strong. The S&P 500, for example, has historically returned around 10% annually on average over many decades, even accounting for crashes, recessions, and periods of uncertainty. The third reason, and this is the one wealthy people understand especially well, is time. Building real wealth isn't about finding one lucky stock that skyrockets overnight. It's about staying invested, consistently, for long periods of time, and letting compounding do the heavy lifting. Index funds are incredibly well suited for this kind of long-term, patient approach, because you don't need to constantly monitor them, worry about which stocks to buy or sell, or react emotionally to every piece of market news. You simply invest consistently and let time do the work. This brings us to something crucial that a lot of people misunderstand about wealthy investors. Most people assume that rich people got rich by picking amazing individual stocks and timing the market perfectly. In reality, most wealthy individuals who built their fortune through investing, rather than through business ownership or a high salary, did it through years, sometimes decades, of consistent, unglamorous investing in diversified funds. The stories that make headlines are the rare cases of someone picking the right stock at the right time. The quiet, boring majority of long-term wealth building happens through patience, consistency, and low fees, not through excitement and prediction. Now let's talk about why this matters so much for people who aren't already wealthy, because this is really the heart of the entire conversation. If you're just starting your investing journey, you might feel pressure to find the next big stock, the next company that's going to explode in value and make you rich quickly. This feeling is completely natural, especially with social media constantly showing stories of people who made huge returns on some specific stock or cryptocurrency. But here's the uncomfortable truth. For every story you hear about someone who got rich picking the right stock, there are countless untold stories of people who lost significant money trying to do the exact same thing and simply guessed wrong. Survivorship bias makes the winners loud and visible, while the losers quietly disappear from the conversation. Index funds remove this guessing game entirely. Instead of trying to predict which single company will thrive over the next decade, which is genuinely difficult even for professionals, you simply own a small piece of hundreds of companies at once. If a few of those companies fail, it barely affects your overall portfolio. If a few of them thrive spectacularly, you still benefit from that growth, without having needed to correctly guess in advance which ones they would be. Let's walk through a simple example to make this concrete. Imagine two people, both starting with $10,000 to invest. The first person spends hours researching individual stocks, picking companies based on news, trends, and predictions, adjusting their portfolio frequently based on excitement and fear. The second person simply puts their $10,000 into a low-cost index fund and adds a consistent amount every single month, without trying to time the market or chase trends. Over a 20 or 30-year period, historically, the second person tends to end up significantly ahead, not because their strategy was clever or exciting, but precisely because it wasn't. They avoided the fee drag of active management. They avoided the emotional mistakes of buying high out of excitement and selling low out of fear. They simply stayed invested, consistently, and let the overall growth of the economy work in their favor. This is exactly why so many financially successful people, despite having access to expensive financial advisors and exclusive investment opportunities, still choose to put a significant portion of their wealth into simple index funds. It's not because they don't understand more complex investment strategies. It's because they understand, often through hard experience, that complexity doesn't necessarily lead to better results, and that simplicity, combined with consistency, tends to win over the long run. Now, let's address something important, because I don't want this video to feel like index funds are some magical, risk-free solution. They're not. Index funds still go up and down with the overall market. During a market crash, an index fund will drop in value just like everything else, sometimes significantly. The difference is that historically, markets have always eventually recovered and gone on to reach new highs given enough time. This is exactly why the wealthy investors who rely on index funds also rely heavily on patience. They don't panic and sell during downturns. They understand that temporary drops are simply part of the process, not a sign that something has gone permanently wrong. This patience piece is honestly the hardest part for most people, harder than understanding the actual investment strategy itself. It's relatively easy to understand that index funds are a smart, low-cost, diversified way to invest. It's much harder to actually sit still and do nothing when the market drops 10 or 20% and every instinct in your body is screaming at you to sell and protect what's left. But this is exactly the behavior that separates people who build real wealth over time from people who understand the theory but fail to follow through with the discipline. There's another reason wealthy investors gravitate toward index funds that doesn't get talked about enough. Simplicity reduces mistakes. When you own individual stocks, you're constantly exposed to the temptation to check prices daily, to react to news headlines, to second-guess your decisions based on short-term noise. This constant checking often leads to emotional decision-making, buying when things feel exciting and selling when things feel scary, which is usually the exact opposite of what actually builds wealth. Index funds, because they represent such a broad slice of the market, tend to generate far less day-to-day drama. There's no single company's earnings report to obsess over, no CEO scandal to panic about overnight. This emotional distance, strange as it sounds, often leads to better long-term decision-making, simply because there's less to be tempted by in the first place. There's also a tax efficiency angle that matters more as your wealth grows. Actively managed funds tend to buy and sell holdings frequently, which can generate taxable events more often. Index funds, by contrast, tend to have much lower turnover, since they're simply tracking an index rather than constantly trading in and out of positions. Over many years, this lower turnover can mean fewer tax bills eating into your overall returns, which is another quiet advantage that compounds in the background without ever making headlines. It's also worth mentioning that index funds work incredibly well alongside other financial goals, precisely because of how little maintenance they require. Someone building a business, raising a family, or focused on their career doesn't necessarily have the time or energy to research individual companies, read quarterly earnings reports, or actively manage a stock portfolio. Index funds allow people to participate in long-term market growth without requiring that kind of constant attention, which is exactly why so many successful entrepreneurs and professionals, people whose primary focus is elsewhere, still choose this approach for the investing portion of their financial life. So how can you actually apply all of this to your own financial life, starting today? First, understand that you don't need to pick individual stocks to build meaningful wealth. A low-cost index fund that tracks a broad market index gives you instant diversification across hundreds of companies without requiring you to become a stock-picking expert. Second, focus on consistency over timing. Rather than trying to guess the perfect moment to invest, consider setting up automatic, regular contributions into your index fund, regardless of what the market is doing on any given day. Third, and this is crucial, commit to staying invested for the long term. Index funds are not designed for quick, short-term gains. Their real power shows up over years and decades, not weeks and months. Here's the mindset shift that ties everything together. Building wealth isn't about being the smartest person in the room or finding some secret stock that nobody else knows about. It's about being consistent, patient, and disciplined, even when it feels boring, even when it feels like nothing exciting is happening. The wealthy people who love index funds understand something that took many of them years, sometimes painful years of trial and error to fully accept. That slow, steady, unglamorous investing usually outperforms exciting, unpredictable stock picking over the long run. If this video changed the way you think about investing, or if it gave you a bit more confidence about starting your own investment journey without feeling like you need to become a stock market expert first, hit that like button. Share it with someone who's been hesitant to start investing because it all feels too complicated, and subscribe to this channel so you don't miss the next video, where we'll break down exactly how to choose the right index fund and how much you actually need to get started. Because sometimes, the smartest financial decision you can make isn't the most exciting one. It's the simplest one, repeated consistently for a very long time. See you in the next video. Until then, keep it simple and keep showing up.